FIFO or first in, first out is used for cost flow assumption purposes. It is an asset management and valuation method, which assumes that companies' assets or inventory acquired or produced first are sold, used, or disposed of first. FIFO assumes that assets with the oldest costs are included in the income statement's cost of goods sold, and the remaining inventory assets are matched to the recently produced or acquired assets. In most companies, FIFO is considered the most theoretically correct inventory valuation method as it matches the actual flow of goods. Selling off the oldest goods first reduces the risk of inventory obsolescence. Therefore, a company would sell the oldest inventory items first and maintain the newest items in inventory. The oldest goods produced or purchased are removed from inventory account first. The remaining inventory items are accounted for at the most recently incurred costs, so that the inventory assets recorded on the balance sheet contains cost that is close to the recent costs that could be obtained in the marketplace. For instance, if 100 items were purchased for $10 and 100 more items were purchased afterwards for $15, FIFO would assign the cost of the first item resold of $10. After 100 items were sold, the new cost of the item would become $15, regardless of any additional inventory purchases made. The FIFO method is allowed under both US GAAP, Generally Accepted Accounting Principles, and IFRS, International Financial Reporting Standards. The FIFO method provides same results under either the periodic or perpetual inventory system. LIFO method is often frowned upon because bookkeeping is far more complex and the method is easy to manipulate. Advantages. The advantages to the FIFO method are as follows. The method is easy to understand, universally accepted, and trusted. FIFO follows the natural flow of inventory. Oldest products are sold first, and the costs accounted for first. This makes bookkeeping easier with less chance of mistakes. Less waste as a company will always be moving out the oldest inventory first if truly following the FIFO method. Remaining products in inventory will be a better reflection of market value. Higher profit. Financial statements are harder to manipulate. Disadvantages. It tends to overstate gross margin, particularly during periods of high inflation, which creates misleading financial statements. Inflated margins resulting from FIFO accounting can result in substantially higher income taxes. With the rise in production cost, companies using the FIFO method to report COGS that do not reflect what materials actually cost at the time the financial statements are released. Alternatively, lower costs are assigned to the goods sold, resulting in inflated profits. Higher income tax can result from higher profits, reducing cash flow and adversely affecting financial position of the company for the next accounting period.